Brent, very good to see you. I'm glad we get a chance to talk today because I wanted to ask you about the recent market volatility. Concerns about a cooling U.S. economy led to a market rout earlier in the month of August, with the Dow down as many as 1,100 points. Stocks and treasury yields, though, did pair some declines after service sector data came back better than expected. Of course, we know volatility and corrections are to be expected, but when we take a look at the S&P's one-month performance, see red, we see green, we see this volatility. What's behind this?
Yeah, so as you can see, a lot of these companies, NVIDIA, Microsoft, Apple, Google, a lot of these heavy-weighted companies in the S&P 500, it's tech. And so
Yeah.
we came off of a bad jobs report, and that's what started that massive Monday drop. And a lot of it was tech where we felt that pain. Now, in my
Mhm.
opinion, yes, it was off of a jobs report, but I think it was a little overblown because we're in an election year. And
Mhm.
so the market reacts, to various things. I think in an election year, it's going to react a little bit more just because of the upcoming uncertainty. So
Mhm.
I love this chart and the way that it shows everything because you can see just how much tech makes up the S&P 500.
Right, yeah, you can see the big squares, it's market capped. And I'm glad you brought that up because as you mentioned, of course, it has been a very strong year for tech. And we've talked about concentration risk before, that 82% of the market movement that we've seen is due to only 10 stocks. Was this part of the correction we saw?
Yeah, so this is amazing. Every time I see this chart, I'm a financial advisor. I'm in this stuff every day, and I'm still just blown away that the
Right.
majority of the market movement comes from just these 10 positions. So when you are fully invested in the S&P 500, which is not something that we normally do for clients, especially ones nearing or in retirement, uh, you're going to ride the wave with these massive companies. And so when things are good and it's going to the moon, man, we're all smiling and life is great. But as financial advisors, we know that today's winners can be tomorrow's losers. And as quickly as they ran up, it's possible that they can pull back. And
Hmm.
so, yes, we saw a pullback. Yes, it was a painful day. But if you would have clicked over to the 1 year return for the S&P 500, the numbers still look great.
Right. And I can pull that up for us because it has been such a strong year. And that's why I wanted to ask. Of course, we all think that we are well diversified if we're invested in the S&P 500, but it's not a well diversified portfolio. How did a well diversified portfolio withstand this recent volatility?
So it did a little bit better. So, if you're fully invested in the S&P, you took the full brunt of that pain when it pulled back. And so for our clients, a lot of them, the large majority are nearing retirement or in retirement. We don't have them fully invested in the S&P 500 because it is so tech heavy. It just does not make sound sense for us to leave our clients completely at the whims of what the big tech companies are going to do. So we
Hmm.
look for a couple lower volatility options to throw it in there because I often tell clients, you're looking for base hits at this point in your career. The saying is you only have to get rich once. Well, we always say you only have to save for retirement once. And so I don't want to put too much risk and into somebody's portfolio. So we're looking for other options out there just to kind of make things more diversified and a smoother
Hmm.
ride.
Hmm. So it's funny, Brent, because in early August, when all of this was breaking, I happened to be on Google and I typed in "should I?" And the first option, as you can see on that drop down, was "sell my stocks right now." So clearly, people were feeling anxious. What should we be keeping in mind, though, when we see these scary headlines?
Yeah, sometimes Kim and I's job is just to be the voice of reason and to calm our clients down when something like this happens because it's very normal to react. Oh my gosh, the sky is falling. I need to get out now. I always tell our clients when we set things up, this is a long-term portfolio. We are built for various market conditions when it goes up and when it goes down. There's never going to be a phone call from us where I'm saying the sky is falling. We have to get out. Usually by the time you can react, the damage is already done. And so I often point out the pandemic and I point out 9/11. Anybody who sold when the sky was falling, they're the ones who locked in those losses. Everybody
Hmm.
else recovered very quickly. And in the case of the pandemic, it went up another 15%. And so we build things for the long term. And so when we have these, we're not going to recommend a knee jerk reaction. It's just not
Right,
necessary.
right. If you have a plan, you don't have to go to Google for financial advice on the day of.
Correct.
Good point.
Absolutely.
So, Brent, if somebody would like your help creating that plan, how can they reach you?
Yep, then go to young-wm.com, look us up. They can also call 614-430-8383, and we would love to chat.
All right. Brent, thanks so much for your time today. I appreciate it.
Thanks, Aaron.